Hello, Super Saver. I hope you're doing well this week. So how could safe U.S. Treasuries destroy your bank? And why might this lead to more bank failures later this year or in 2024? That's what we'll be talking about today. And in particular, here are the 4 questions I'll be answering. How banks make money with your money. How this became a problem in 2022. How safe U.S. Treasuries could destroy your bank if not managed properly. And what you and I can do about this possible ticking time bomb. For our chart and table lovers, you'll want to watch until the end. That's when the most interesting, albeit slightly scary, numbers show up. Also, do keep in mind as you watch this video that, as always, I don't have a crystal ball. What I'm sharing with you is based on my analysis and interpretation of publicly available data, which I've linked in the description below if you're interested. And of course, remember that past performance is not necessarily indicative of future results or events. Now that I've mentioned our disclaimer, which you can also read at the end of this video, let's dive in. Here's a quick refresher on how your bank makes money with your money on the most fundamental level. Say that you have $10,000 and you deposit it into an account or buy a CD with it at your bank. Your bank pays you interest on this $10,000. Your bank then takes this $10,000 from you that's now in their possession and lends the money out to a borrower. And the borrower pays your bank interest on the borrowed amount. And of course, this interest rate that the borrower pays to your bank should be higher than the interest rate on the $10,000 that your bank is paying you. And that's the first way that your bank makes money, by lending out your money at a higher rate than they pay you in interest and keeping the difference as their income. Now, let's say that from this $10,000, your bank lends out $8,000 to the borrower. It can't lend the full $10,000 out because what if you want some of it back at some point, right? That leaves the bank with $2,000, which the bank can then put to use elsewhere. Usually, they'll invest most of this amount into U.S. Treasuries and or other liquid safe assets, which will pay interest on the invested amount. And that's the second way your bank makes money with your money, by earning a bit more on that invested money than they pay you in interest. Do keep in mind that the 80-20 ratio that I'm using for this example is for illustrative purposes only. The percentage will vary depending on the bank. On the most basic level though, this is how a bank works and how it makes money with your money, leaving aside other lines of business like issuing credit cards, brokerage, and so on. And this part, investing in treasuries and other liquid safe assets, this was fine and chugging along like a machine, so long as interest rates were relatively stable and low, like they've been over the past few decades. If you happen to want your $2,000 back, your bank could have just sold some of these liquid investments with hopefully a bit of profit, or worst case, at a small loss. So far, everything was looking good then, but more on that later. The Fed raised rates fast and high last year by a mind-boggling 4.25%. Throughout 2022, the Federal Open Market Committee raised the federal funds rate target range from 0 to 25 basis points to 4.25% to 4.5%. Many super savers benefited from those rate hikes via the T-bill and CD ladders that we taught you on this channel, or simply by taking advantage of some of the attractive rates for money market funds, CDs, and savings accounts that we talk about regularly here. But those rate hikes, they didn't necessarily benefit the banks so much. There are many reasons why not, including that many people use their spare cash, withdrew that money from their bank to buy other investments as they started to show attractive rates. And if you're interested in learning more about these many reasons why not, then drop a comment below because it helps me prioritize what videos I should work on next for you guys. In today's video, we're going to talk about this reason here though, because it's the elephant in the room that took Wall Street, that took everyone really by surprise. These supposedly safe and liquid investments were one of the key reasons Silicon Valley Bank collapsed overnight, as safe US Treasuries became a ticking time bomb. And it could potentially destroy your bank as well if not managed properly, which I'll be talking about in the next section. Remember when I said earlier that if you happen to want your $2,000 back, your bank in normal times would have just sold some of these treasuries and other liquid safe investments without a major loss or even with a small gain because interest rates were relatively stable and low for a long time. Well, what happens if you wanted your $2,000 back now in 2023, but your bank had invested that $2,000 into a 10-year treasury note, or worse, a 30-year treasury bond that they purchased at the beginning of 2022 when the federal funds target rate range was between 0 and 25 basis points. With the federal funds target rate now in a range between 4.75% and 5% at the time of this taping, it means that if you did want your $2,000 back now in 2023, your bank would have to sell these treasury securities at a significant loss. Because remember, when interest rates go up, the prices of existing treasuries go down. And that's what SVB had to do. In a nutshell, they took quite a bit of their customers' deposits, this $10,000 in our illustration, that could mostly be withdrawn at any time, and invested a lot of those deposits here into long-dated treasuries and other government-backed securities to get a slightly higher return, without building an emergency fund large enough to cover unexpected expenses, or in their case, unexpected withdrawals. As an example, that's the equivalent of you and I taking the vast majority of our emergency savings and putting it into a 10-year treasury note or a 30-year treasury bond and giving ourselves, say, maybe a week or two as a buffer in hard cash. I guess the SVB folks didn't watch this channel. They didn't ladder properly. And as so often in life, an emergency did come up when they needed it the least. When customers started withdrawing their deposits at a faster rate than anticipated, SVB had to sell these long-dated treasuries and other investments in a rising interest rate environment to meet depositor withdrawals, meaning they had to sell at massive losses. That was their first major mistake. Now, to be certain, there were a number of other factors that led to SVB's collapse, including, but not limited to, over-concentration in the startup tech world, where nascent firms were burning through cash, withdrawing their deposits to pay expenses as new funding dried up. About 94% of deposits at SVB were not insured. They were above the FDIC limit. So it looked rational and prudent for customers above the FDIC limit to withdraw their cash deposits to get them into safety. Being a part of the West Coast startup world, which sometimes feels like a small, close-knit community, when a few investors started telling those nascent firms to pull money out of SVB at the first sign of trouble, word spread fast, and this contributed to and amplified an emerging bank run, and no bank can survive a bank run. In my mind, though, those factors we just talked about are SVB specific and not as relevant to the banks that you and I do business with. But the elephant in the room, this possible ticking time bomb that could destroy your bank if not managed properly, this illustrative $2,000 invested in US Treasuries and other investments could be relevant to the banks you and I use. Our banks would and do also invest this hypothetical $2,000 into US Treasuries and other investments as well, similar to SVB. So are our banks laddering properly? And if not, if they had to sell the stuff here early, could they absorb the hit to their financials and still remain standing? How massive would that loss be on such an early sale? Massive. That loss is massive. At the lower limit, we're talking about $340 billion. And at the upper limit, about $620 billion for the US banking sector. That's how massive. Which brings us to how safe US Treasuries could destroy your bank if not managed properly. To be clear, US Treasuries are safe as safe as it gets in terms of credit risk, as the super savers on this channel know. For all practical purposes, U.S. Treasuries carry no credit risk because they're guaranteed by the full faith and credit of the U.S. government. So you can trust that you'll get your money back when your Treasuries mature. And U.S. Treasuries are also among the most liquid investments in the sense that you'll almost always find a buyer without having to look around too much. They are, however, not safe in terms of interest rate risk because they are fixed income instruments, as many of you with longer-term Treasuries and other bonds found out last year when the prices of those existing securities in your portfolio plummeted with rising interest rates. So yes, you'd probably find a buyer for your Treasuries quickly if you needed to sell them, but this buyer may not be willing to pay the price you expected. Listen, it's no fun watching the market price, the potential sales price of your 10-year Treasury go down and then further down in a rising interest rate environment. It's downright painful some days and weeks. But if you don't need to sell that 10-year Treasury, if you're planning on holding it to maturity, it doesn't really matter because along the way to maturity, you'd still get the interest payments you had initially planned on getting. And at maturity, you'd still get the full principal back, and you will overall have made exactly the return that you had initially planned on getting. That declining price of your 10-year Treasury in the market during these times of rising interest rates, they're just paper losses, unrealized losses at this point. Painful to watch, but not really a loss. The problem comes when you do have to sell that 10-year Treasury suddenly in an emergency, say because your car breaks down. That 10-year Treasury that you are planning to hold to maturity, when you have to sell it before maturity into a higher interest rate environment, that's when those unrealized market losses, those unrealized paper losses become real losses. And that was the second major mistake that Silicon Valley Bank made. Not only did they invest a lot of customer deposits, which should have been readily on hand and available, into long-dated treasuries and other government-backed securities in a rising interest rate environment, without building an emergency fund large enough to cover unexpected withdrawals, they also categorized those investments, this illustrative $2,000 here, in their financial statements as hold to maturity, often referred to as HTM, rather than as available for sale, or AFS. Let's walk through a relatable example to demonstrate the danger when banks or we misclassify investments as hold to maturity versus available for sale. Say that your wife or husband gave you $10,000 in 2022 to set aside for emergency car repairs. You then decided it was a good idea to invest that $10,000 into a 10-year Treasury note at 1.5%. Remember, this was last year when cash really was not earning any interest. So it could have looked like a good idea back then to make at least a bit of interest with a safe investment in US government paper. And for the super savers who've been on our channel for a while, yes, I am having car trouble, and no, Marcus did not, thankfully, buy his 10-year tips with our emergency money. Anyway, back to our example. Today, in early 2023, your wife or husband says to you, "Honey, how much do you have set aside for emergency car repairs because the car's been making funny noises?" And you say,
$10,000.
Well, that's wrong because you've categorized that $10,000 as hold to maturity in your head, like SVB did in their financials, when that $10,000 should have been classified as available for sale because there's a strong likelihood you'll be needing that money before maturity and having to sell your beaten down 10-year Treasury at a loss very soon. And the difference between the hold to maturity price of $10,000 and the available for sale price of, say, $8,500, this $1,500 is what we call in the industry unrealized losses. At the end of 2022, the banking industry had a whopping $620 billion in unrealized losses, about 55% of which, so approximately $340 billion, was attributable to hold to maturity securities, the red bars. The remaining amounts were attributable to available for sale securities, the yellow bars. As you can see, the higher the Fed raised rates throughout 2022, the bigger the unrealized losses became. And the concern is primarily on hold-to-maturity securities rather than available-for-sale securities, because without diving into the weeds, the unrealized losses on available-for-sale securities are already accounted for elsewhere in a bank's financial statements. Or, in our car repair example, you have it already in your head that you'll only get $8,500 back when you have to sell those bonds right now, and you budget accordingly. The unrealized losses on held-to-maturity securities, however, aren't obvious unless you really dig into one of a gazillion tables, which in JP Morgan Chase's most recent annual report was on page number 218 of a 328-page document. Again, using our car repair example, that's the equivalent of thinking in your head that you really have those full $10,000 in the bank, even though you could find out that they are worth quite a bit less if you simply logged into your investment account and looked at the current market pricing. And to be fair, the unrealized losses on hold-to-maturity securities by a bank should, in theory, be reported at maturity value. And the unrealized losses is good to know, but fine to ignore if the bank has properly categorized their investments in that hold-to-maturity bucket and really only put in securities that they will actually be able to hold to maturity. So again, as an example, if you know for certain that you're putting $10,000 into a 10-year Treasury note for when you retire in 10 years, if you will actually hold it to maturity no matter what, then the unrealized losses or gains from daily market fluctuations that you'll see between now and that 10-year maturity date are irrelevant, because you're not selling your 10-year Treasury note before maturity, no matter what. Also, as you can see from this chart, between 2008 and 2021, when interest rates were relatively stable and low, before the Fed started its series of rapid rate hikes, there were many years when banks actually had unrealized gains on their security portfolios. It wouldn't have made sense then for banks to report those unrealized gains either, because again, they were holding to maturity. So along that line of thinking, if banks aren't reporting unrealized gains, then they shouldn't have to report unrealized losses either. The problem with this way of thinking, and especially in our current high interest rate environment, is twofold. One, these potential losses may now be too massive to ignore. And equally important, two, it assumes that our bank, or banks in general, have properly categorized their investments as available for sale versus hold to maturity, and that they can follow through on their intent to hold to maturity. Because what happens when a bank miscategorizes money, investments, which should have been readily on hand and available, as hold to maturity securities, when really they need to sell them right now because they're running out of money? Well, when a bank does that and then ends up having to sell hold to maturity securities to meet immediate cash needs, it turns some of these unrealized paper losses into real losses that will surprise basically everyone. And that's when safe US Treasuries can potentially destroy that bank. Because if those losses are so significant that it wipes out that bank's equity, that's when that bank may fail, like SVB did. Now, banks that are publicly traded need to make their financial statements available to the public at regular intervals, so investors do have a fair bit of transparency. However, for banks that are not publicly traded, it's nearly impossible to find out how much that bank has in held-to-maturity securities and how much the unrealized gains are or losses are unless this bank decides to voluntarily publish this information, which may not always be the case. So now what? Right, I just gave you the bad news. Lots of unrealized losses in our banking system currently. Not knowing whether bank management teams have properly categorized investments as hold to maturity and whether they'll be able to follow through on their intent to hold to maturity. And finally, the near impossibility of finding this information for banks that are not publicly traded. Here's the good news. Not all banks have the same approach to risk management, and hold to maturity securities allocation as SVB. And that's why we have FDIC insurance, to protect our hard-earned savings in banking institutions. Let's start with this first point first because, well, I like to go in order. I'll be honest, when we look through SVB's numbers, it's almost as if they threw as much as possible into the held to maturity bucket. Let's take a quick look at their held to maturity securities allocation versus some sample banks to show you what I mean. I'm going to use JP Morgan Chase, Citibank, and Wells Fargo for this comparison, primarily because they were the first to report their earnings in April, so we have more context to work with. For those of you who've watched this GSIP video, which I've linked below, JP Morgan Chase, Citibank, and Wells Fargo are 3 of the 8 GSIBs that we consider to be among the safest banks in the US. And all the numbers we'll go through now are as of the end of December 2022, from the latest publicly available financials we have before the next ones come out later this month and in early May. This column shows the value of each bank's held to maturity assets. This column shows the unrealized losses on these held to maturity assets. And this column shows the total shareholders' equity. Think of total shareholders' equity as the total amount of money that investors, shareholders, have put into that bank to support its growth. And this column shows the unrealized losses on held to maturity assets as a percentage of total shareholders' equity. And this column shows the net income. Compare the percentages from JP, Citi, and Wells to SVB. If we take JP, what this shows us is that even if they had to sell all their held to maturity assets and take this loss, they would have enough shareholders' equity to cover this loss. These unrealized losses are equivalent to basically 1 year's worth of net income. Citibank and Wells Fargo would also have enough shareholders' equity to cover these unrealized losses if they had to sell all their held to maturity assets and take these losses. The unrealized losses are equivalent to a bit more than 1.5 years worth of net income for Citibank and 3.25 years worth of net income for Wells Fargo. Silicon Valley Bank, on the other hand, would basically have wiped out their equity to take the unrealized losses if they had to sell all of their held to maturity assets, which of course is exactly what they were trying to do. Their unrealized losses on held to maturity assets as a percentage of total shareholders' equity was 94%, the equivalent of about 7.5 years worth of net income. Now, seeing this did help me sleep a little better, as most of the other banks seem to be in a much better position to absorb any losses they may have to take. Now, let's move on to the second piece of good news. Unrealized losses from held to maturity securities is what's top of mind right now for this banking crisis, because as I said earlier, it's the elephant in the room that Wall Street that no one had really expected. But it's only one of many other factors that determine the success or failure of a bank in our current environment. And these factors that determine the health of a bank, they're generally not easy for the average person to find, and even less easy for the average person to dissect and understand. Regularly watching this channel will help though. And of course, that's one of the main reasons why we have FDIC insurance, so that you don't need to find these numbers. You don't need to analyze them and then try to make an assessment about your bank's health or likelihood of survival. And the same is also true for the folks who get paid to do this professionally. They don't always get it right either, as we've seen. Even if your bank has allocated securities as hold to maturity when they can't really follow through on their intent to hold to maturity, and even if your bank has massive unrealized losses, and even if your bank does everything they could possibly do wrong, your money is still FDIC insured, up to $250,000 per depositor per FDIC insured bank per ownership category. So now you're probably wondering,
Jen, why in the world did I just bother watching this video then?
well, because as I mentioned earlier, unrealized losses from held to maturity securities is what's top of mind right now for this banking crisis. And you'll probably be seeing and hearing more about this in the coming months. And along with it, headlines like how safe US Treasuries could destroy your bank, how safe US Treasuries became unsafe for banks, how the Fed broke the banks, and so on. And when you do, I want you to remember this video and the fact that safe US Treasuries are as safe as it gets in terms of credit risk, so long as you can manage the interest rate risk and ladder properly. And as unsafe as they may be for banks, which have not properly managed this interest rate risk and which have not laddered properly in a rising interest rate environment, and which may have classified certain securities as held to maturity rather than available for sale, your money is still safe. It's still protected, so long as you stay under the FDIC threshold. For those of you who haven't seen our FDIC 101 video yet, check it out here to learn more and see how you can increase your FDIC insurance in certain instances with your bank. All right, Super Savers, so the next time you hear something about how unsafe US Treasuries might be, think about it in the context of everything we talked about here today. So I hope you enjoyed this video and learned something new. And as always, if you did, don't forget to share with those you care about. And of course, hit that thumbs up, and see you again very soon with another brand new wealth building video.